Real estate is definitely not the right vehicle for every investor. And if your objective is passive income for your retirement, where you don't have to sell assets, you can just live off the income, it is really worth examining whether or not you should be investing in real estate. Now, I love real estate investing. I manage a lot of real estate investments for our clients. However, there is a huge difference between owning the income that asset produces and owning the business and the hassles with managing real estate on your own. Because the reality of direct ownership is that it's not the passive vehicle that most people think it is. Being a landlord is not for the faint of heart, I assure you. Getting quality contractors, dealing with problem tenants, dealing with maintenance issues, having large capital reserves when inevitably things start falling apart. And oftentimes these problems pop up at horrible times when you are vacationing, you are with your family, perhaps over the holidays, and you have to address those issues right then and there. You can't just wait till next week to deal with a leak at a property. And so all of this begs the question, are you investing in real estate to grow your wealth and to grow your income, or did you accidentally just buy yourself a new job? And so after 20 years of investing in real estate and income investments on behalf of high net worth investors, we're going to cover the details on why I think it's not a great idea to invest in rental real estate directly. And then more importantly, what are your other options? What can you do with this capital to generate income and achieve some of those same goals without all the hassles? Okay, but before we do that, let's talk about the misunderstandings that people have with real estate investing and how it gets them in trouble once they buy that first rental property. Number one is thinking of a single family home, a rental, just a normal house, as a cash flow investment. Now, what do I mean by that? Well, most people get into real estate for the cash flow benefits and they default to single family homes, just regular homes that they can rent out, perhaps something in their neighborhood or something that they could drive to where maybe they can do the handiwork, they can improve the property themselves versus hiring a bunch of contractors and spending a ton of money with vendors. And yes, that is a viable business. You can generate cash flow from those assets, especially if you can buy a number of them, spread the risk around, and are getting great deals on these assets, or just really good at renovating and improving the amount of rent that you can charge. But the vast majority of people kind of do basic repairs to a regular stick-built home and then try to earn a spread above what they are paying a mortgage lender, what they're paying on their debt versus what they are charging the renter. And that's all well and good, but the problem is they're not really thinking through all the expenses that they're going to have to pay over time. And a lot of those expenses can outpace inflation. They can even outpace the rent increases that you could pass through. And so you got to think through your underwriting. You got to think through the cash flow model, property taxes, insurance, repairs and maintenance, appliances, and obviously the mortgage payments. But the one thing that people forget to budget for or dramatically underestimate is capital expenses. What am I talking about? I'm talking about roof replacement, foundation issues, when you have a tenant turnover and they trash the place and you have to spend a lot of money on getting the house ready again for the next tenant. These are larger line item expenses that unfortunately can wipe out months, if not years, of prior cash flow. That's especially true of the roof. That can be true of water leaks or replacing the AC units, replacing the ducting throughout the house. Anybody who's ever owned a home knows that there are a lot of random big ticket items that pop up every once in a while that are bummer expenses because they don't really improve your enjoyment of the property. They kind of just allow you to maintain the status quo. And this can be especially painful for a rental property because when you put a new roof on an asset, it's not like you get a bump in the rent to pay for that. Because say the roof on your rental is leaking and you're going to have to put in a new $20,000 roof, because it's not like you can just pass that cost through to the tenant in terms of a higher rent increase. They barely care about the brand new roof. They just want a functioning property. It's not like the new appearance of the roof is that great and can justify a higher rent expense. It's just a roof. Nobody cares. It's functional. Yes, it might look marginally nicer if it's new, but it's not going to demand a rent premium. And the tenant and the building and the neighborhood, nobody cares that you've already burned through your maintenance budget, that when you first analyze that property, that's the amount of money you thought you were going to spend that year, and it's 3, 4, 5 times that amount this year. Nobody cares. And you don't get to just skip these expenses and be a slumlord, right? You're dealing with real people and real families. So this is the first real problem with buying investment real estate. People make overly optimistic assumptions about the expenses, the profits, the amount of downtime they're going to have between tenants, the amount of capital expenses they're going to pay. What you need to do before you purchase an asset like this is be really conservative with the assumptions you're making on expenses and the capital expenses you're going to have to pay over time. You could just assume the worst case scenario and then spread that out, that amount each year. Assume that over a 10-year hold, you're going to be spending a fair amount on these improvements. So at least you're somewhat prepared when something eventually does fall apart. And then if you zoom out, if you think about all these expenses and these capital surprises that can pop up, it doesn't leave a lot of room for error relative to the amount of rent that you can charge for that market. So unless you have some unbelievable strategy how to buy homes and properties extremely below market, where you're effectively building in that margin by your really cheap purchase price, well, then you can't really think about and count on this property being a cash flow asset. It's highly unlikely to be a cash cow. You have to think about rental real estate as more of an appreciation game, which is why I tend to think about single family home rentals as more of an appreciation game than a cash flow business. You can think of these more like a little piggy bank for your net worth growth that you're going to have to deal with from time to time, but ideally, as time goes on, hopefully you're gaining some appreciation, and ultimately, as you pay down your mortgage for that rental, you have a nice chunk of equity that you've built out over time that hopefully has outpaced inflation by a lot. And one day you can sell it for a big number, and then you can get paid for all of that work, all of those years where you're fielding these calls and dealing with those headaches. You can finally get the benefit of this investment when you go to sell it. Now, a lot of people have made good money doing just that and become quite wealthy, but once again, hard to make that a cash flow business. Usually you have to be very patient in order to get your returns from a one-off rental property, because the cash flow usually gets consumed by the mortgage and the ongoing repairs and maintenance that pop up from time to time. In other words, you're constantly reinvesting back into the property in order to be able to still get that future rent. And so that outcome's fine. If you want that appreciation and you kind of want to think about it as putting that money away for 20 years, great. But appreciation does not pay for a retirement unless you're selling assets. And it also creates concentration risk because you have one tenant. All right, the second problem here is that you are overly concentrated into one asset typically if you're investing in just a rental home. You have one tenant, you have one market, you have one structure, you have one regulatory environment and city officials to deal with. And so unlike a portfolio of diversified assets where you're spreading around those individual risks across the portfolio, and so if you get unlucky on any of those things we just talked about, one random bad tenant that's a professional tenant that knows how to work the system and live in your home rent-free for a year, which does happen. Well, in that situation, never mind cash flow, you actually are having to write checks to your property because your lender certainly isn't going to care that your tenant is a jerk and not paying you. So that doesn't feel like passive income. You didn't buy mailbox money. You bought a business. And that requires you to pay attention to it, requires you to deal with problems that pop up, which is why rental real estate tends to not fit with the goal of recurring income for a retirement. All right, so what can you do instead? Now, I think there's really two main ways that you can go about this and still getting exposure to real estate and accomplish these goals. And the first of these options is great, but the problem is most people either don't have the experience or the time or desire to actually pull this off successfully. And so this option is a real estate syndication. This is investing with a professional operator, either in a property or preferably into a fund, a diversified pool of properties where they are the expert, they are the ones maintaining the assets, dealing with the day-to-day issues, underwriting and finding these new properties to purchase. They're covering it all and sending you checks. You're writing them a limited partner check where your risk is limited to your investment amount, and they are the general partner, and they are going off and making the investment and doing the heavy lifting so you can benefit from the passive income and hopefully the distribution checks that they will send you over time. And this is a perfectly good option if you know what you're doing, if you have access to these deals and know what you're looking at. And if you really want to go down that route, I highly recommend you spread your money around. You don't just put it with one sponsor, with one general partner in one property. Ideally, you're putting it into a portfolio of properties with several sponsors, so you're spreading around your risk. I see people make this mistake all the time where they have a certain amount of money that they can dedicate to a real estate strategy to generate passive income for them, and they put it all into one real estate syndication with one sponsor, which is just a different form of concentrating the risk. They've gotten away the hassles of having to deal with the property themselves and They're not having to dedicate their time and effort, but they haven't solved the concentration risk. So make sure you protect your capital through a little bit of diversification. Okay, and now for the better option, I think, for most people that are looking for passive income. If you want to get exposure to real estate, generate income, and not worry about the hassles, and do that in a diversified, lower risk way, which is really what we're trying to accomplish here. We're not trying to generate 20% IRRs, 20% type of returns through cash flow into real estate. Because if you think about the investment and the goal that you're trying to accomplish here, you want cash flow coming from your asset here in real estate that is durable, reliable, where you don't have to sell something to enjoy the benefit of the returns. You just get these checks that come in the mail, either quarterly or monthly. If you think about that goal, well, then real estate debt is actually, I would argue, a much better fit for most investors looking to fund their lifestyle through something like real estate investing. Because there's a lot of benefits in investing in a different part of the capital stack, the debt versus the equity, which is the first to realize losses, that most investors don't really think through or appreciate. Number one, usually the income's higher. Right now, it is very difficult to invest in real estate at interest rates that are 6, 7, 8% on some of these commercial real estate properties that actually generate any cash flow in the near term. Most investments in good markets are still generating a fair amount of high competition to buy those assets, and therefore it's really hard to generate positive cash flow when your interest, your debt on that mortgage is so high. You're buying into the property, you're paying all those expenses, the mortgage rates are high, and so just like the scenario we talked about with a one-off stick-built home, it's still very difficult for even the professionals to generate a lot of cash flow early in a business plan because of that dynamic, because of high interest rates. We'll see what the Fed wants to do, whether or not they lower interest rates anytime soon, but when you look at most apartment buildings or industrial assets or even retail centers today, there's not a lot of cash flow in the early years of these investments, and so you're not really accomplishing your goal of getting cash flow quickly through real estate by investing in these commercial assets. Whereas if you invest in real estate debt, you're becoming the bank, you are becoming the lender. And that interest rate is pretty high right now. So you're getting the benefit from day one, that first month, there's going to be a mortgage payment made to the lenders. And if you think about it, there's no expenses that come with that mortgage payment. The lender doesn't have to pay insurance or taxes or utilities or what have you on that mortgage revenue. And so you're getting higher monthly yields, but you're also doing so with less risk because you are investing in the debt of the property. Oftentimes there's 30 to 40% of equity above you that is cushioning your risk. A lot of equity has to be vaporized before your investment is impaired at all. Your mortgage, your loan is secured by that asset, by the property. If the borrower fails in the middle of the night, you get to take title to that asset and then sell it, and you have a giant spread between likely the value of the property relative to the loan value. And sometimes you can recoup some of that margin if you just sell it outright on the market. Other times, as long as you get your loan balance back, you're thrilled, and you can just make a new loan to another borrower. And I would argue that now, after we've already had a 20% plus correction in a lot of different real estate asset classes and markets, is even a better time to be investing in real estate debt from just a safety standpoint, from a risk standpoint, because you've already had valuations come down a bit. And so you're investing your debt at an even lower attach rate, so to speak. And so you're lending at a reduced valuation than people that were lending to properties in 21 and 22 when things were a little frothier. So I would make the case that now you have even more cushion relative to valuations and historical value. So I would argue that where we're at in the real estate cycle, you're in a better position as a lender than you were just a few years ago, which makes it even better time to be putting money to work in this strategy. Now, the other thing about reducing your risk via real estate debt is that you're usually doing this in a very diversified way. You usually don't invest in one real estate loan. Usually you're investing with a real estate lender that has a giant pool of real estate loans that they've made, whether it's in a single asset class or it's across all commercial real estate types. And so you're kind of removing the outlier risk of any one individual loan having some disaster that would make you incredibly unlucky. In other words, if you just made one loan on a single property, a lot of random things, black swan events can happen. You can get a weather event, you can get a regulatory action, you can get that crazy tenant. The dispersion of possible outcomes is quite wide. Whereas if you're investing in a giant portfolio of diversified asset classes in different markets and different strategies, whereas if you're investing in a diversified portfolio of loans, it's highly unlikely that there's going to be a lot of distress across all of those assets. And so if you're investing in a lot of different loans in different locations and asset classes, you've removed a lot of that weird outlier risk. Okay, so why now? Why real estate debt investing today? For a couple reasons, but in part because a lot of real estate needs to be refinanced. There's about $900 billion of pending commercial real estate loans that are getting close to their maturity window. They need to be refinanced or sold. And so this is creating an opportunity for private real estate lenders to come in with fresh capital to make these loans at attractive prices, at attractive loan basis, at interest rates that, if you look historically, are quite high and quite healthy. In other words, you're lending at higher interest rates, so your returns are higher, and arguably your risk is lower than it was during the last cycle. And so that's a pretty good setup for attractive risk-adjusted returns because you're lending at higher interest rates, and yet I would argue you have lower risk than the people that were making these loans 5 years ago. Okay, who should consider real estate debt for their portfolio? I think anybody that wants current income with a lower risk profile than equity, that likes the idea of contractual payments coming into them, often monthly, but this person often has to have a fair amount of wealth where they have enough cushion, enough liquidity to make this illiquid investment, right? You can't just get out of a debt vehicle the next day. Just like real estate, you can't sell property the next day. It takes time. And of course, distributions are not guaranteed. There is still risk in investing in debt. There's just typically less invest than investing in equity for obvious reasons. So once again, nothing against real estate. I love real estate. We invest in new real estate assets on behalf of our clients every week. The point is not that real estate investing is a bad idea. My point is that if your goal is passive income in a more contractual way with a lower risk profile, you're probably better off in a real estate debt investment than you are in an equity investment, or especially than investing in rental properties on your own, which are the furthest thing away from, quote, passive investing. All right, thanks for watching. There's resources down below.